The assignment from last round, quickly. We can go over that if you guys would like. Assignment from round 3C. First question was, provide at least 3 methods a team might employ to increase its leverage ratio. Not often would you really want to increase your leverage ratio necessarily, would you? But actually, there are cases that you would. Okay, leverage can be a decent thing, as we find out. I think oftentimes when I ask these questions, I'm trying to get across the point that you could improve your ROE oftentimes in a big way if you're willing to take on a little bit of leverage. Okay, it also brings risk. Yes, it does. Okay, but leverage can be a good thing in terms of return to the investors. So I put A, borrow money for whatever reason. Right? If you borrow money, what are you going to do? You're going to increase your liabilities. You're going to increase your assets. And our definition is assets over equity, right, for leverage. So that would increase that ratio, right? Because if you started with 100 in assets and 50 in equity, and you increased them, that'd be a 2-to-1 ratio. You increased them both you increased your liabilities by 50 and your assets by 50. Then you'd have 150 in assets, and you'd still only have 50 in equity, right? And so your ratio then would go to 3-to-1. B is pay a dividend. Okay, kind of the opposite reason then. In that case, we're reducing both our equity and our assets. Okay? But in reducing both our equity and our assets, we're going to increase the ratio. Does that make sense? Okay. And lastly, buy back stock, which basically has the same effect as paying a dividend. We decrease both when we buy back stock, we're decreasing our equity account, okay, and we're also decreasing our assets because we have to expend cash. That list isn't necessarily exhaustive. I don't know if you guys had some other ideas off the top of your head or other things that you might have put down. Okay. What's that? Yeah.
They could raise their prices and increase sales by reducing prices.
Well, that would increase your assets. If you increase your sales, it would depend. I'll have to take a look at that one. Because you'd increase your assets by, well, no, you wouldn't, because you're going to sell. Yeah, you would to the extent of your margins. You'd increase your assets. If it made no other changes, that would keep your deal the same. But you might increase your assets and your equity by the same amount in a case like that if it went to retained earnings. I'll have to see what you wrote down and follow that one through. Somebody else have something? Okay. 2, assume Chester paid a $5 dividend per share last round, round 3. What impact would that have had on, and if applicable, show the numbers, ROE? It would increase our ROE, right? Because we're dividends, once again, dividends get paid out of equity. Okay, get paid out of equity. Oftentimes the retained earnings portion of your equity is where we pay dividends out of. And the calculation on that is 5 times $2 million, so it'd be a $10 million dividend that we would have paid, right? And so our equity, that's at $65,189,000, would have been reduced by $10 million to $55,189,000, would have given us a new equity, and their income was $1,601,000, and you divide that by the new equity, so its ROE would have increased to 2.9% compared to 2.5%. Right? And EPS, any effect would be nominal, right? Really wouldn't be any effect on earnings per share. You could argue some things in there about having to borrow money or giving up money and those types of things, but the effect would be pretty nominal. 3, in the real world, what does PE stand for? PE stands for price to earnings ratio. It's a fairly common ratio that we like to look at. It again is not, it's not an apples to apples, okay, ratio necessarily. If you look at the PE ratio for Apple versus the PE ratio for What would be another, well, let's take a look at one here. How many people in here use Snap? Just a couple of you? Or Snapchat, is it? Snapchat? How many people? Snap's the ticker symbol. I'm sorry, I call things by the ticker symbol. So, what do you think its price to earnings ratio is? It's a brand new stock. It just had its IPO a couple weeks ago. Okay, so it's brand new to the public market. I think it does have some earnings, but not a lot. Okay, and so I'll bet you its price to earnings ratio is maybe going to be triple digits. We'll see. Maybe we'll see. Maybe it doesn't even have a price to earnings ratio yet. It's so new. Yeah, well, because price to earnings here would be trailing 12 months. See if they got a price to forward down here. No, they don't even list it because it's too new. Apple's price to earnings is actually pretty low right now. Yeah, moderately low. You know, Apple's a mature company. Okay, it's no longer that fast-growing thing. You know, its forward PE is at 14. Okay, yeah, that's we would call that semi. I don't know. I guess I'd call that moderate. Historically, the whole market's usually about 14 to 15, so it's kind of right in that zone right now. The market right now overall is a little closer to 18, 19 on a price to earnings ratio. If you took all the companies together and you added them all up, it'd be closer to 18 or 19, I believe. I was trying to think of another good company that maybe would have a real low or a real high price to earnings ratio. Yeah, off the top of my head, I'll come up with some here as we go along. And I asked for what's the PE ratio for Facebook. Facebook's ticker is FB. The forward PE is 21.5. The TTM, and I don't care which one you gave me, hopefully you at least you mentioned it, 40.2. So what's the difference? Why is its trailing price to earnings ratio twice as high as its forward price to earnings ratio? Anybody got a clue there? The TTM is actual earnings for the past 12 months. So why would its forward price to earnings ratio be so much lower? They're anticipating a big increase in earnings. Okay? The projections are that they're going to have a big increase in earnings. That would be the only answer, right? Katie?
Why, when I looked at it, when I was doing this, was it 0.29%?
0.29%. Wouldn't have been the price to earnings ratio. Must have caught something else.
Yeah.
And what that would have been, I'm not sure. It's an interesting number to look at. It's like I say, I like to follow more of the overall market and where it's at in terms of price to earnings ratio. We've gotten the market out of hand. If you go back to the .com period in the late 1900s and we had the .com bust, the market got up to a total of about 24, 25 on the price to earnings ratio. That's kind of unprecedentedly high. That's really high. Okay, so we're sitting about 18, 20 right now. That's pretty high. Okay, again, I think there's a lot of exuberance over what might happen, in the near future here in terms of tax reform and those types of things, and it's kind of pushed the market a little bit higher. So we'll see. But earnings have been improving too. If earnings went way up, price earnings ratio comes down, right? Okay. If earnings stay flat, prices go up, then you get an increase in the price to earnings ratio. So, and your numbers may vary a little bit from these, right? Depending on the day, depending on the price that Facebook was on the day you looked it up. So they could be a little different. That's fine. 4, what's the difference between market cap and book value? What's the book value of Facebook and what's the market cap of Facebook? Here I want you to understand the difference because this gets to be kind of important. The market cap's what people are willing to pay for, right? And that's just the number of shares outstanding times the current market price. Okay, the number of shares outstanding times the current market price. That's what the market cap stands for, capitalization, short for capitalization. Okay. That's completely different than what its book value is. Okay. Book value then is simply the accounting value, which is assets is equal to liabilities plus owner's equity, or however you want to state the accounting equation. Assets minus liabilities equals owner equity. You can move it around however you want, but that's all it is for book value. Book value is important. It takes into consideration depreciation of those assets which can be depreciated, and also amortization, those assets which get amortized, which can be kind of important. It's not an apples to apples comparison, and I'll show you a couple different things. So Facebook, relatively new company, it's only been around, what, 8-10 years, already has a market cap of $405 billion. Okay, huge, right? Huge. That's bigger than a lot of companies. And let me just look at something down here just to give you an idea. Total assets, if we look at its book value, it'd be the stockholders' equity here, which is $59 billion. So its market cap is what, 6 2/3 times bigger than its book value, which is a huge difference. Okay. You think, and Facebook doesn't make anything, right? They don't make one darn thing. They just get you guys to look at things online, and they turn that into money somehow. It's magic. Okay. And they have $405 billion market cap. And if you looked at a company like Ford, for example, which has been around forever, right? It's a huge company, employs lots of people, makes lots of cars that you and I drive. We're all familiar with Ford. Its market cap is $45 billion, 1/10 the size of Facebook, right? Isn't that kind of interesting how it's so different? GE's a bit bigger. It's been around for quite a while. It's far more diversified. I think it's bigger than Ford. Huge company, right? I mean, they make all kinds of things. Yeah, they're $255 billion, so decent sized company there. What's the biggest market cap company in the world? It may be on its way to $1 trillion in market cap, but it's not quite there yet. Anybody know? I just had it up. It's about 3/4 of $1 trillion. Next year or shortly thereafter, Aramco, which is Saudi Arabia's kind of state-owned oil company, is possibly going to go public, allowing normal people to buy shares in that. They think it would be bigger than Apple, that it might be over $1 trillion if it goes public, which would be by far the biggest ever public offering, initial public offering that any company's ever put out. So it'd be kind of an interesting thing if it does go public. Total assets here for total assets are $320 million for Apple. If you broke down their financial statement, just so you know, about $250 billion of that's just cash that they have sitting. So really, they don't, they got $70 billion, which is a lot, don't get me wrong, but they don't have a lot tied up in equipment and factories and all those things, right? They contract out most of their manufacturing and those types of things. So they don't have a ton tied up in those things. And mostly what they have on cash, most of that cash is sitting overseas. And I think virtually all of it's sitting overseas. So. Any questions about those? And again, your numbers may have varied a little bit on these, and that's fine for the Facebook. Just hopefully you were in that ballpark. No questions? All right.